Is Chief US Strategist at Ned Davis Research. He's with us. Ed, good to have you with us here. Thank you very much for your time. As a lot of these estimates start to come in, and we were talking about this yesterday morning as well, this how much US will collect in new tariff revenue. So $250 billion, $300 billion a year. The Trump administration, in that sense, will get more emboldened, right? To push back, ask, and firm up their stance with regards to deals, etc. I'm talking about this in the context of what's happening here with India. When in April, before April, it looked like India would be first in line to perhaps get a deal. But now, of course, we understand that it's not likely before the 1st of August deadline. What is your sense, Ed, just to sort of begin the conversation there?
It seems like the Trump administration has backed itself into a corner somewhat by putting on first a 90-day pause and then another 30-day and now almost indefinite, where if the countries they are negotiating with don't like the deal, then they can stand firm, and then the Trump administration likewise will just extend it. So it seems that it's going to be extend and pretend for a while until both sides can come to an agreement, and that extends to dozens and dozens of countries. So this is probably going to be a story that's going to be with us for months and months to come.
Ed, hi, good morning. Good to have you on the show today. What do you make of the market's interpretation, and maybe the market's latching onto exactly what you said, that this is going to go on for months in negotiations, even with the EU, right? We had comments overnight saying that nothing stops countries from talking to the US, even after the 1st of August. So do you think this, from an economic perspective, will not be that disruptive, at least this year?
So in terms of the actual economic impact, I think it will be a slight negative, but probably not enough to cause a recession in the U.S., which, of course, was a big fear a few months ago. My concern is the longer this goes on, the more it's going to lead into capital expenditures not coming to fruition. If a company has a CapEx plan that's already been executed, they're probably not going to stop it because of a tariff negotiation. But they're probably also not going to do some of the new projects until they know what the new rules are. And so if it's a 90-day pause, that's one thing, but this is something that goes on for 6, 9, 12 months, then that's going to show up in the actual economic data. So the soft data that's been kind of weak could become percolating through the hard data. And, the U.S. is such a consumer-based economy. CapEx is not as big of an impact or a bigger part of the economy as some other markets, but it has an outside impact on the growth rate, because the multiplier effect on CapEx is so much greater than it is on consumer spending. You could see U.S. economic growth slow down quite a bit, not necessarily into a recession, but you could see a significant slowdown if these tariff negotiations drag on for a while.
Hi, Ed. Good morning. Good to see you, Ben. This is Nigel on this side. In terms of equity market allocation, you're overweight emerging markets. Tell us, where does India fit into this scheme of things from the emerging market basket? And, what about valuations? China seems to have a cushion out there, but India has growth, earnings growth. So how are you positioning yourself within emerging markets?
India has been one of our longer-term favorites for lots of reasons. Better demographics than many other countries around the world, including many emerging markets. And potential for growth in a lot of sectors that seem to be doing well globally. So I think there's a lot of positives for India. That's a longer term call for the most part for us. But so within emerging markets, we think India is probably a pretty good place to at least have a good market weight or a little bit overweight allocation.
Ed, data has all been pretty strong, right? I mean, one can nitpick, but US data, and actually, this is the views so far about the US has been that H2 will be weaker, and it'll all start to show up. Maybe it will, but so far, what we've seen has been rock solid data and rock solid earnings as well in the US, and on top of that, now you are talking about potentially a new stream of revenues every year, hundreds of billions of dollars. So, you know, the Trump team would think, well, they're winning. And they may be winning. I just wanted your thoughts there, Ed.
Well, I think first of all, there's no such thing as a free lunch, and so I think there's a long-term danger from tariffs that isn't going to show up in 2025, maybe not even 2026, where the U.S. economy will become less competitive if we don't have as much competition from other countries. And that was a problem in the U.S. in the 1970s, and then through deregulation, we became more competitive. But the challenge was there was a whole swath of the country, the manufacturing sector, that suffered from that. So there needs to be somewhat of a balance there. So that's a longer term situation. But short term, the U.S. economy is driven by consumer spending. As long as we're adding 100 to 150,000 jobs a month, which we have been doing, then I think there's a pretty good chance that the expansion can continue. And so far, the earnings numbers have been very solid. The big banks have already reported for the second quarter. Most of them exceeded expectations. Now, they're not going to have as much of an impact. In fact, a lot of them had great trading revenue from the market volatility. We'll get a better sense in the next, say, 3 or 4 weeks as more companies that are more directly tied to the real economy report. My hunch is there'll be a bit of a mixed bag. Most companies are still going to be okay, but you're going to start to feel the pinch of tariffs, which showed up in last week's CPI data as well.
Yeah, a little bit of an increase coming through. But as you're saying, I think the base case right now is no recession, maybe a bit of a slowdown. And the markets are taking that in their stride. But we'll see. We'll see what the next couple of weeks bring. Thank you very much, Ed, for joining in. Good conversation. We look forward to many more in the near future. Well,